Imagine losing nearly $1 trillion in just a matter of minutes. Sounds impossible? Yet that is precisely what happened on May 6, 2010, in the event that became known as the flash crash. In less than 36 minutes, the U.S. financial market plunged into a collapse so swift and so violent that it remains, to this day, a chilling reminder of the fragility of the systems that underpin the global economy. It all began in the most unassuming way. In a modest room in West London, a man named Navinder Sarao was trading futures contracts tied to the S&P 500 index using nothing more than his personal computer. That afternoon, around 7:40 p.m. London time, he closed out his day's trades. The result looked spectacular. Nearly $1 million in profit, an achievement that any ordinary trader might spend months, even years, trying to reach. But, ironically, exactly 60 seconds after he shut down his computer, the New York Stock Exchange plunged into chaos. At 2:41 p.m. New York time, the S&P 500 index nosedived almost 10% in just 4 minutes, instantly erasing nearly $1 trillion in market value from American companies, according to the U.S. Securities and Exchange Commission's 2010 report. The chaos was so intense that shares of Accenture collapsed from $40 to just 1 cent in seconds, while Apple briefly traded at $100,000 per share, reaching a momentary market capitalization of $54 trillion, more than the entire global GDP recorded in 2023, which stood at $99 trillion according to the World Bank. How was this possible? How could a supposedly secure and regulated system allow a $30 billion company to be valued at less than $10 million in an instant? Or let a giant like Apple become, for a few seconds, more valuable than the entire world economy? These are not just absurd numbers. They reveal something deeper. A market where the speed of machines was already beginning to surpass human reasoning. But the question that haunted investors and regulators was inevitable. Who triggered this lightning implosion? Was it the work of a lone operator like Sarao, or the reflection of a systemic failure at the very heart of the financial markets? The flash crash of 2010 not only shook confidence in markets, but also exposed vulnerabilities that remain all too relevant in today's world, dominated by algorithms and automated trading. And this is only the beginning of the story. The birth of the flash crash. May 6, 2010, began under heavy clouds for global markets. Europe's sovereign debt crisis, which was already eroding confidence in the bloc, was sending waves of panic through trading floors. According to the European Central Bank, Greece had revealed only weeks earlier that its fiscal deficit had soared above 13% of GDP, a figure that cast doubt on the stability of the entire Eurozone. Across the Atlantic, American investors followed every headline out of Athens with growing unease. At 9:30 a.m. in New York, the trading day opened with clear signs of turbulence. The VIX index, often called the Fear Index, surged more than 22% throughout the day, according to the Chicago Board Options Exchange. This indicator, which measures implied market volatility, was flashing red. Something extraordinary was about to happen, and it did. At 2:32 p.m., a massive order hit the futures market for the S&P 500 75,000 contracts, valued at more than $4 billion. To the average observer, these numbers may sound abstract, but imagine that someone suddenly dumped into the market the equivalent of the annual budget of a country like Croatia, according to International Monetary Fund data from 2023. It is obvious that the system was not prepared to absorb such an impact. Within minutes, liquidity evaporated. Between 2:41 and 2:45 p.m., the S&P 500 dropped almost 10%. Trading volume exploded to 2 billion shares in just 20 minutes, totaling $56 billion, according to the Securities and Exchange Commission. Irrationality took over. Accenture shares plunged from $40 to 1 cent, while Apple skyrocketed from $250 to $100,000 per share. As if the company could suddenly be worth $54 trillion, a figure greater than the combined GDP of all nations in 2022, estimated at $96 trillion by the World Bank. But this was not just a spectacle of charts and numbers. Think of the ordinary investor who had his savings locked into retirement funds. In seconds, he watched his nest egg disappear from the screen, unsure if it was a system glitch or the start of a global meltdown. How many people, panicked, sold their shares for pennies, only to watch the market recover half an hour later? The flash crash brutally demonstrated how confidence, that invisible but vital element, can unravel in minutes. And although markets managed to recover that afternoon, one question remained. Who had pulled the trigger that brought everything down? Who was Navinder Sarao? Who could have imagined that one of the central figures in a billion-dollar market collapse was living in a modest bedroom in his parents' house in London? Navinder Sarao, born in 1978 into a working-class British family, looked nothing like the stereotypes of Wall Street. No expensive suits, no glass-walled offices. He traded from the comfort of his bed, yet he moved sums larger than the annual budgets of entire nations. Sarao's story began at a firm called Futex, where in the mid-2000s he learned to trade futures contracts. For many, this type of trading seems abstract, but in practice it is straightforward. Agreements to buy or sell assets at a predetermined price on a future date. In the case of the S&P 500, each contract represents 50 units of the index. This meant that with only modest initial capital, a trader could control enormous volumes, multiplying both profits and losses. Sarao demonstrated unusual talent. In 2008, at the peak of the global financial crisis, he bet on a recovery following the massive bank bailout packages. While millions of people lost homes and jobs, he turned $2 million into $15 million in a single week, according to reports in the Financial Times. Was this pure genius, or simply being in the right place at the right time? But luck does not last forever. By 2009, Sarao noticed that the easy profits were fading. The reason? The rise of so-called high-frequency trading, a style where supercomputers execute millions of orders in fractions of a second. According to the New York Times, July 2009, these systems already accounted for more than 50% of all trades in the United States. How could a lone trader compete against machines capable of detecting market trends in milliseconds? This reality check created a dilemma: quit or reinvent himself. Sarao chose reinvention, but the path he followed would put him at the center of one of the most controversial financial scandals of the century. If the story so far sounds like that of a solitary genius struggling against the machinery of Wall Street, the question remains: how far can one man go when he decides to fight the system? The answer would come with the rise of an invisible, relentless new force, the algorithms that would soon dominate global markets. The arrival of the robots. What if I told you that, starting in 2009, much of the decision-making behind trillions of dollars in global markets was no longer in human hands, but in lines of code? That is exactly what happened with the rise of high-frequency trading. According to the Tab Group, by 2009, about 60% of all trades on U.S. exchanges were already being executed by algorithms. Today, Nasdaq estimates that the figure still hovers around 50%, proving that machines continue to dominate the game. These programs operate on a timescale impossible for any traditional investor. While a human takes seconds to click a button, a trading robot can process millions of orders in milliseconds. The result? Crushing advantages, capable of turning the smallest market fluctuations into massive profits. As the New York Times warned in July 2009, machines can detect patterns before the human investor can even blink. But it wasn't just about speed. Ethical and regulatory concerns soon emerged. Some exchanges began offering, for a fee, early access to order books, granting high-frequency firms a head start of mere milliseconds. It may sound negligible, but it was enough for these robots to buy cheaper and sell higher before anyone else could react. This created a distortion. Small investors and even large traditional funds were being systematically outpaced in an unfair race. And then came the shadow of manipulation. In July 2009, the New York Times reported how fake orders were flooding trading books, placed not to be executed, but to deceive other traders. This practice became known as spoofing. To put it simply, it was like putting a house up for sale with no intention of selling it, just to trick the neighborhood into raising or lowering prices. Navinder Sarao watched all of this with growing frustration. The profits that once seemed certain were now being swallowed by invisible robots he couldn't defeat with intuition alone. Instead of retreating, he decided to learn from his enemies. He built his own algorithm, not to compete on equal terms, but to exploit the very tricks that were distorting the market. A micro-conflict emerges. Could a lone man, sitting in a bedroom in London, really turn the tables on Wall Street's most powerful machines? What he did next would cross the thin line between brilliance and illegality, and the price would be paid in front of the entire world. The bedroom trader and his machine of manipulation. What Navinder Sarao did next was not just bold, it was a deliberate rupture with the rules. He built his own high-frequency trading robot and began using it for practices known as spoofing and layering. In simple terms, he flooded the market with thousands of fake orders, creating the illusion of overwhelming buying or selling pressure. When other traders reacted to this artificial movement, Serrao would swiftly cancel the fake orders and place real trades, profiting from the manipulation. This kind of tactic was already illegal, though at the time, U.S. law lacked a precise definition. According to the Commodity Futures Trading Commission, CFTC, Serrao placed and canceled thousands of orders within milliseconds, something no human could possibly detect in real time. The layering technique involved scattering fake bids and offers at different price levels to simulate stacked demand. The effect was devastating. He could artificially steer the direction of the market, and it worked. On some days, Serrao made hundreds of thousands of dollars. On May 6, 2010, the day of the flash crash, he moved about $200 million in futures contracts and pocketed $950,000 before shutting down his system, according to Financial Times reporting. Here lies the reflection. How could one man, alone in a bedroom, command volumes equivalent to the GDP of entire nations? Was Serrao merely exploiting obvious flaws in a market already corrupted by big banks and hedge funds? Or had he crossed definitively into outright crime? The most striking part, minutes after Serrao ended his trades, the market collapsed. Coincidence or causation? Later investigations would show he was not the direct trigger, but his activity added fuel to an already unstable market. His orders represented up to 20% of all sell-side volume in the S&P 500 futures that day, according to the CFTC. Imagine a game where every player believes they are competing on fair terms, only to discover that the board has been rigged from the start. That was the environment Serrao created. And though his cleverness was undeniable, the line between intelligence and fraud is thin, and he had crossed it without hesitation. But if Serrao was not the sole culprit, then who really pulled the trigger that plunged markets into historic chaos? The investigation and the true culprit. The flash crash left deep scars. Investors, regulators, and politicians all demanded answers. Who had pulled the trigger that wiped out nearly $1 trillion in minutes? Initial suspicion fell on Navinder Serrao. After all, his fake orders accounted for up to 20% of the selling pressure that day, according to the Commodity Futures Trading Commission, CFTC. But soon, the evidence pointed to something even more unsettling. In 2014, a study published in the Journal of Finance revealed that the collapse could be traced back to a single massive trade. At 2:32 p.m., one investment fund unleashed 75,000 S&P 500 futures contracts worth over $4 billion. The order was executed by an algorithm programmed to sell quickly, without price limits. The crucial detail: the fund assumed that higher trading volume meant deeper liquidity. But in 2010, much of that volume was fake, generated by high-frequency robots buying and selling in milliseconds without ever holding positions. The result was catastrophic. The algorithm dumped contracts at breakneck speed, flooding the market in less than 20 minutes with a volume that would normally take 5 hours to absorb. The illusion of liquidity created by the robots collapsed instantly, and there were not enough real buyers to sustain prices. That was the spark that ignited the crash. Even so, Serrao's case was not forgotten. The CFTC detected abnormal patterns of thousands of orders canceled within seconds, clear evidence of spoofing. The case was referred to the U.S. Department of Justice. In April 2015, Serrao was arrested in London and charged with 22 counts of fraud, including commodities manipulation and wire fraud, crimes that carried a potential sentence of up to 380 years in prison. According to the Financial Times, he admitted to making more than 85 fraudulent trades on the day of the crash, earning about $12.8 million through his scheme. Here lies the dilemma. If the true trigger was a massive fund deploying a poorly programmed algorithm, why did a lone trader become the most visible face of the crisis? Was Serrao merely a scapegoat, sacrificed to prove that regulators were taking action? The answer would lie not only in Serrao's trial, but also in the systemic reforms the flash crash forced upon the global financial system. The legacy of the flash crash. The flash crash was not just an isolated event. It exposed the fact that the global financial system, increasingly driven by algorithms and high-speed trading, could collapse in minutes. Authorities responded quickly. Just 2 weeks after the crash, then-President Barack Obama signed the Dodd-Frank Act, which for the first time provided a clear legal definition of spoofing and expanded the powers of regulatory agencies. According to the Securities and Exchange Commission, the episode served as a wake-up call, leading to the implementation of new circuit breaker rules, mechanisms that automatically halt trading during moments of extreme volatility. For Navinder Sarao, the outcome was ambiguous. Arrested in 2015 and charged with 22 counts of fraud, he faced up to 380 years in prison. Yet, by cooperating with investigators and helping regulators understand the hidden manipulations of the market, he managed to drastically reduce his sentence. In 2016, he received only 1 year of home detention, according to the Financial Times. But the story did not end there. Many analysts argue that Sarao became a symbol of a much deeper problem. While he paid the price for his crimes, similar practices continued on a far larger scale within major financial institutions. One striking reminder: after the 2008 financial crisis, only a single individual was jailed in the United States for crimes tied to the mortgage collapse, despite millions of families losing their homes, according to the report of the Financial Crisis Inquiry Commission. Was it more convenient to punish a lone wolf than to confront the political and economic weight of holding Wall Street giants accountable? The legacy of the flash crash still reverberates. In March 2020, at the onset of the pandemic, circuit breakers were triggered 4 times in just 10 days, something unprecedented since their creation. This proves that, despite reforms, the risk of systemic instability remains. And if the old danger was high-frequency algorithms, today it is compounded by new forces: artificial intelligence in finance and the growing interconnection of global markets. What have we learned after all? That confidence is the true foundation of markets, and that no matter how sophisticated technology becomes, just a few minutes of panic can erase trillions. Navinder Sarao's case is an uncomfortable lesson. It does not take an army to expose the flaws of a system. Sometimes, all it takes is one man in an ordinary bedroom. If you have followed the story this far, it means you believe that understanding the past is essential to deciphering the future. Subscribe to the channel, like and share this video. Thank you for staying with us until the end, and be prepared, because the next collapse may be closer than we think.